Good morning, good afternoon, good evening, and welcome to our 308th weekly webcast. Now, if this is the first time you're joining us, welcome. If you've been with us before, welcome back. And so the way this call works is this is an AMA, like you see on Reddit, meaning ask me anything. You can ask me business questions, investing questions, personal growth questions, startup questions, any questions you want to. And my humble goal on this call is to help you take your career, your portfolio, your happiness, your personal growth to the next level. So further ado, let's begin and thank you. I'll kick it off here with Ray, who's asking the variable interest entity structure that Chinese companies are using it. Isn't it too big of a risk? If China bans VIE structures, or else such investments could lose massive value overnight. Please explain. Yeah, absolutely. So the way it works is American and international companies, for the most part, are not allowed to own more than 50% of a Chinese company. So a workaround from this is Chinese companies are setting up what are called VIEs, or variable interest entities. And what that means is the Chinese company creates a new company offshore in, say, the Cayman Islands, for example. Then they give control to the American company, for example. And the benefit of this is that the American company can then list that Chinese company on the New York Stock Exchange. Now, there's a couple of risks with this. Number one, I don't think the Chinese government will allow this to go on much longer. I think they'll crack down. And number two, in my humble opinion, and what I'm about to say is not a negative thing about Chinese people at all. It's just the Chinese accounting system. I don't trust Beijing's accounting system. I've been burned many, many times by investing in Chinese stocks. And the same thing goes with Russia. Many years ago, when we were allowed to invest in Russia, I invested in Gazprom and Lukoil, which are massive energy companies in Russia. And I did the financial due diligence. I was like, oh my God, these things trade at 3 or 4 times earnings, a PE of 3 or 4. But those numbers were wrong. Yeah. Okay, next question is there a reasonable period during which a company has to turn profitable? Like Roblox, despite being around for 20 years, hasn't yet reached profitability. Even for Netflix, Tesla, it took less time than that. Yeah, absolutely. It all depends on the investors. So there's two classes of investors. There's either growth investors that like to buy expensive stuff like me, and there's value investors that like to buy cheap stuff like Mr. Buffett. Now, every company goes from growth to value eventually. But I don't want the companies that I'm investing in that are growth, meaning expensive companies, to be very profitable. And let me explain why. So if I'm investing in a company that's very expensive, that's growing very fast, yes, they can cut all sales and marketing expenses, and they can cut all R&D expenses, and these expenses will go right to the bottom line, meaning if revenue stays unchanged, which will probably slow down, then profit goes up a lot. I don't want that, though. And I think that sophisticated investors, at least growth investors, tend to value companies based on their earnings estimates in 5 or 10 years. I never invest in a company because it looks cheap this year. It's ludicrous to do that because everybody else does that. So what I like to do is I like to forecast financial statements 5 or 10 years out. Then I like to value the company based on my earnings estimates in 5 or 10 years. And so many years ago when I worked in the hedge fund industry, I remember I owned Amazon. I was long Amazon, ticker AMZN. And people said to me, Chris, this is a widowmaker. You're crazy to own this stock. It's over 100 times earnings. And I said, no, it's 3 times my earnings estimates in 10 years. And so you never look at valuing companies based on this year's earnings or trailing earnings. It doesn't make sense. You got to think long term. And that way you can sleep at night knowing that your target price is here. And you can tell yourself, I don't care about the path, I care about the destination. Now, I've got to do a very quick hockey reference because I am a proud Canadian. And by the way, what's going on right now with Trump, with Canada and whatnot, when Canadians, and I'm a proud Canadian living in the US, when Canadians are booing the national anthem, it's not against Americans, it's against American policy. And Canada loves the US, and hopefully this is behind us soon. Okay. Back to Canadian reference. So my favorite athlete of all time, Wayne Gretzky, and there's a stock market reference coming here. He would always say that he wouldn't invest or he wouldn't skate to where the puck is. That's why he was successful. Rather, he would skate to where the puck is going to be. And by the same token, we have to think the same way when we invest. We have to invest in stocks that people are going to like. How do you do that? Well, you create a financial model, which I teach in my MBA degree programs and other courses. You create a financial model, you forecast earnings out 5 or 10 years in your income statement. Then you value the company based on your PE multiple 5 or 10 years out. That way you can sleep at night, Now, if you buy the same stock that everybody loves today, there's not that many incremental investors to buy it and push it higher. So be a contrarian and watch your net worth take off, always. Otherwise, what happens is, as Mr. Buffett said, who's a value investor, the New York Stock Exchange is the only store in the world where consumers sell stuff and it goes on sale. You'll freak out at the wrong times. Always think longer term. The longer the view, the wiser the intention. Okay. Next question is it advisable to have a stop loss strategy for any stock we have? At what level? Could you give an example? Yeah, absolutely. Yeah. I would document a stop loss, but I wouldn't have it in an automated system. And the reason why I wouldn't put it like good till completed GTC in a trading system is sometimes stocks intraday can be really volatile, right? Somebody can have a fat finger and push it the wrong way. So you can do it manually if you want to. Now, let me talk about sizing up positions. So Tony Robbins, many years ago, and I met with him. He convinced me, by the way, I met with him. I introduced him to one of my portfolio companies in VC. He convinced me to teach, so God bless him, and quit VC. I'm happy I did. But what he said was this: everything in life comes down to pain and pleasure. So, for example, if you see a chocolate cake in front of you right there, oh, it looks good. If you eat it, you're going to get this much pleasure, but you're going to have that much pain in the long run. It's the same thing with stocks. We think about risk versus reward. What does that mean? Well, whenever you look to invest in a company and you do your due diligence, you want the upside to be much better, much bigger than a downside. So if a stock is $10 right now, if your target price is $20, that's $10 upside. And if your downside, the risk level, is $8 because it might be a support level, then that's $2. Sorry, England, this way. So 10 minus 2 is 8. It's positively skewed. So you always want your risk reward to be very, very positive. How do you do this? Well, what you can do, and I hate looking at technical analysis as the primary reason for investing, but I'm going to give you an example. Okay. So let me actually go to finance.yahoo.com and I'll pull up, I don't know, first company I think of, Tesla. You know why I'm thinking that, because I saw Donald Trump there. All right. So let's say that you do a lot of due diligence on Tesla, okay? And let's say that you do due diligence on Tesla. Let's say it's in the past year. Okay. So you do due diligence right here. Okay. In hindsight, it's 2020. Okay. Right when Trump won the election, and Elon Musk's net worth went up $140 billion, which, by the way, he invested $250 million in the Pennsylvania campaign for Trump. So $250 million divided by $140 million is a massive return. So, but right here, let's say you invest it. Let's say your target price was $400, right? It's a PE multiple based target price in your financial model. What you could do is you could have a stop loss that is right below the channel here. So let me actually show you what this means. So what I'm going to do is I'm going to take a screen print of this and I'm going to draw for you very quickly what a technical support level might look like. Here we go. Good. All right. So let me get a pen right here. All right. So there's a channel formation. Give me 1 second. It's fun doing these things live. Here we go. Okay. So there's a channel formation right here. It's not perfect, okay, but right about here. So again, it's back in November, you bought the stock. And over time, you're monitoring it, and you see a channel formation, roughly. It sticks within this channel. If it violates the channel, which it certainly did right here, okay, then that might be a stop loss level. But you want to make sure that your upside is way higher than your downside in the long run. And quite often what people do is they use stop loss levels that are not channel formations, but are support levels. So let me go down here and I'll show you. Okay. So right here, let's say we invested in Tesla, I don't know, last May or something. Your stop loss level might be below this line here, so to speak. Okay. But what I really want you guys to do is focus, number one, on valuation. Secondly, fundamentals, and third, technical analysis. Let me show you. So this is one of the templates I provide my students with, and this is just dummy data here. You focus first on fundamentals, always. Secondly, valuation. Third, technical analysis, okay? And your price target is usually based on a PE multiple. That's your upside, okay, your reward. Your risk is usually based on some technical level, which you can outline in the technical analysis part of your research. Now, when I tell my students, and this is for all my clients here, this spreadsheet, along with many others, to look to invest, it's based on my experience working at Goldman, hedge funds, venture capital, etc. And I'll never tell you what to buy, but I'll provide you with all the tools. So instead of giving you a fish, I teach you how to fish. So what you do is you fill out all 100 steps, okay, meaning qualitative research, quantitative, and financial, and I explain all this stuff from scratch as well. Then what happens, what comes out of this is a target price, okay, and we look at 3 different target price valuation methodologies, okay, and I like to look out longer term as well, year 6 to 10. What comes out of that is a 1-pager right here, okay, which I just showed you, a 100-page report here, as well as an investment dashboard right here. So always do your own research, and please think very, very long term, because again, the longer the view, the wiser the intention. Okay. All right. All right, next question is, how do you project costs when you want to model a company that is not yet profitable? Yeah, I'll show you right now. So as you guys know, I love to use props when I teach. When I was younger, actually, origin story, in the 6th grade and the 8th grade, they wanted to fail me in school because they thought I had a learning disability. But I just wasn't passionate. I couldn't pay attention. So I like to use props, like show and tell, right? Okay, so when you're forecasting a company, it's a lot easier than you think. And the reason that we want to forecast a company's financial statement, the reason is because we want to figure out what net income is. Net income is the same thing as net profit and earnings. So if we can forecast what earnings are going to be in 5 years, then we could slap a P multiple on that in 5 years for our target price. So what you do is this. You start off forecasting revenue. Okay, so forecasting financial statements is so much easier than you think. A lot of people feel really intimidated by it. But all you have to do is this. You forecast revenue or sales, and it's called the top line because at the top of your income statement, okay? So what you're going to do is you're going to forecast this out 5 or 10 years. And you might think, Chris, how do I do that? WTF, why the face? Sorry. Well, the way you do it is you look at historical patterns, okay? And obviously there's a lot more to it. But if you see that revenue historically is growing like this over the past 5 years, okay? An object in motion stays in motion. So here we are in the present. Where do you think it's going to be next year? Probably here and probably here, okay? So you look at the rate of growth, okay? And if they buy a company, then revenue will spike that year, for example. Okay, great. So we're done with revenue. An object in motion stays in motion. Now we do next is most expense items, like the red ones you see here, are 8% of revenue, right? So if the cost of goods sold is 10% of revenue, and it's been about 10% for the past decade, then forecast it as 10% going forward. The same thing with all these bad boys here. General administrative, research development, and sales and marketing. You look at them as a percent of revenue, these expenses. And if you find that, for example, sales and marketing 5 years ago was 15% of revenue, then it went down to 14% 4 years ago, then 13%, then 12, then 11, and 10. You might be able to forecast that by looking at that pattern. Of course, you'll never go to 0%, but I think you get the idea. And the reason you do all this, and only do it for cash-based expenses, like don't include, there's a reason there's no depreciation here at all, okay? And there's a reason why there's no stock-based compensation or amortization. Cash in, cash out, okay? So this is kind of like forecasting a cash flow statement. Then, once you have net income forecast out a number of years, then you value the company. So what target price should you put on a company then? Well, it depends on the growth rate. So if we forecasted that earnings in 5 years is going to be $1, okay, $1 in earnings. And if the growth rate between years 4 and 5 is 20%, what do you value the company at? Well, a simplistic back of the envelope way to do it is this. If it's growing at 20%, you slap a 20 multiple on it. So if you get $1 in earnings in 5 years, then that means that this company should be valued at 20 times $1 in 5 years, or $20. If the growth rate between years 4 and 5 is 10%, then slap a 10 multiple on it. I think you guys get the idea. And this works because historically speaking, the S&P 500 trades at about, this is very, very, very rough, 15 times earnings. And the S&P grows earnings on average, the S&P 500 companies, about 15% per year. So that's the same growth rate, right? A price earnings of 15 divided by a growth rate of 15. So it's 1 to 1. Very simplistic way to look at investing. And when I was running hedge funds and working on Wall Street and stuff, what I used to do was if I saw that a company was trading at more than 2 times its growth rate, it might be a short. If it was trading at well under 1 times its growth rate, probably going to be a long. And there's of course many other factors you have to incorporate as well. Okay, let me move on to the next question. Okay, and give me 1 second here. All right. Next question is, when you invest in a growth company, do you calculate the 5-year forward PE? If yes, how does it mean? Do you divide the current stock price by the cumulative EPS for all 5 years? How do you interpret? No. So the way you do it is this. You forecast out, let's just say, 5 years worth of your income statement, okay? Then, as I mentioned a second ago, if you get, say, $1 in earnings in year 5, and the growth rate between year 4 and 5 is 20%, you'll slap a 20 times multiple on that. You will not add up all 5 years worth of EPS. What you're referring to indirectly is doing a discounted cash flow, which is more complicated than that. I can show you examples how to build that if you want me to. All right. Next question I've got here is, Ray wrote, ChatGPT, which hallucinates all the time, careful, says value investing outperforms growth investing. Please comment on that. Yeah, it's partially right. So value investing, meaning Mr. Buffett's style of investing, meaning buying cheap stuff, value investing has outperformed growth investors between 1920 and around 2010 or so. Okay, but since actually 2008, right after the Great Recession, growth stocks have outperformed. So it all depends on the environment we're in right now. Yeah. So if we're in a horrific recession, okay, and the government has to cut interest rates a lot, value investments are probably going to outperform, like Coca-Cola or Campbell's Soup, which has a healthy dividend yield. And stocks that will underperform probably include some tech stocks that are expensive, like NVIDIA, for example. Great questions. Keep them coming. All right. And then today, by the way, guys, I forgot to mention, today I actually have to leave the call 30 minutes early. So we have another 1 hour and 13 minutes right now. I have to jump on another call. All right. Next question is, currently the United States is in a high interest phase. Yeah, well, historically, I don't know if it's that high. Maybe if you look at this century, yes. But interest rates have been in the double digits back in the early 80s, et cetera. So you wrote, currently it's in a high interest phase, which reduces inflation. Yeah, correct. Yeah. Higher interest rates, meaning inflation down, right? But the problem right now with tariffs, and you guys see how the markets have been selling off in the past couple of days. The problem is with tariffs, it means that a lot of these expense items go up because it's more expensive for American companies to buy stuff from international companies to produce stuff. And that means that net income goes down. And if you're not assuming a price earnings multiple contraction, that means stocks go down, which they have. In fact, the stock market is now, I think it's below or around the level where it was around November 3rd when President Trump won the election. Tariffs can be very dangerous. I really hope, and I say this with love in my heart, Mr. Trump, I hope you're using these tariffs as a negotiation tactic, and then you'll pull them kind of like you delayed tariffs on the big 3 automakers yesterday for a month. Okay. Then you wrote, what is better for stocks? Yeah. So it all depends. Okay. So if we're in a recession, and a recession is defined as 2 consecutive quarters of negative GDP growth. GDP, growth domestic product, think of it as revenue for a company, for a country. So if GDP goes down year over year, 2 consecutive quarters, that's a recession. And if we're in a recession, typically, it all depends at what phase of the recession, but early on, value stocks might outperform. Stuff like Campbell's Soup, ticker CPB, anything that Warren Buffett tends to buy. And growth stocks, like really expensive high growth companies, like NVIDIA or other chip makers, whatever, those would underperform. Depends where we are in the economic cycle. Okay. All right, next question is, would you invest in a company that does business primarily in China and does business mainly through its subsidiary in Hong Kong? Isn't it risky again? Yeah. Again, as I mentioned earlier on in this call, and this is not a knock on anybody from China. What I'm about to say is a knock on Beijing. That's right. Meaning the government of China when it comes to economic and accounting policy. I don't trust Beijing's accounting. Okay. We've all been burned, us veterans, on Wall Street investing in Chinese stocks that looked really, really cheap. Okay. So I would need to fully trust and understand the accounting. Garbage in, garbage out. I've invested in Chinese companies pardon me, over decades. And some of them work out well. Like if it's Baidu, it might work out well, right? If they're dual lists on the New York Stock Exchange or NASDAQ. But other companies I've looked at, don't believe the numbers. You can't. So anyway, those are my humble thoughts. Again, that is a knock on Beijing's accounting policy, and that's it. Okay. All right, next question is, I like this one. When you download XBRL file from Edgar on a PC, how can you mark and read it all? Do you use RL or any other tool to work with this file and how? Yeah, great question. So what he's referring to, that's Ray, right? Ray, you got great questions, man. What he's referring to is if you go to sec.gov to look at financial statements, let me go there with you, okay? And let's go, I was looking recently at Microsoft. If you look at the financial statements of Microsoft, for example, let's just take the 8K, meaning the recent press release, which was their December quarter. Okay, you can see their financials will be in here, but what you can also do is up here, you can say, hey, don't show me the text-based stuff. Show me in this format called XBRL. And it's impossible to read, but if you have a program like RL, you might be able to read it that way. I think it's a waste of time. I just look at it this way. Now, if what you want to do is you want to download financial statements, it's harder to use sec.gov for that, right? So if you look here at the financial statements for Microsoft, here's the income statement, right? It's a pain in the ass to be able to download this. You have to, copy and paste. So what you can do instead is you can use, there's many websites to do this, use one called BAMSEC, okay? And so with this company here, BAMSEC, I think it's like $60 a month or something, which is nothing for Wall Street firms. What you would do is you would click here, this is Apple as an example, on their quarterly report. And then what you can do is you can download the financial statements here directly, right? So all financial statements, you click download, and it pulls it directly into Excel or Google Sheets. Okay. All right. Great questions. Keep them coming. Again, I do have to cut the call in about, we have an hour left. I got to cut out early today. But for those of you, my silver, gold, platinum, and diamond programs, we still have our 3 hours of Zoom calls today starting at 10 a.m. Pacific time. Yeah. Okay. Okay. Next question is, would you recommend finding a tiny profitable company with a market cap of $50 million that is undervalued and growing fast, for example, micro and nano caps for better ROI? Yeah, it all depends. You got to make sure that they're very liquid. A lot of hedge funds went belly up in the fall of 2008 because they owned illiquid stocks, meaning stocks that don't trade very much. And illiquid stocks own you in a down market rather than vice versa. So what kind of liquidity should you look for before investing in a stock? So I'm going to show you. And I'll pull up some random example here. I'll use a company other than Tesla this time. Okay, so I'm going to go here to finance.yahoo.com. Let's just go to Agilent, I guess. Okay, here it is here. Okay, good. So this company here, Agilent. So you want to look at the average daily trading volume. So the average daily trading volume of this stock, ticker letter A, is 1.7 million shares. And the rule I used to use when I managed money professionally, and even personally now, is you never want to buy more than 10% of the daily volume. So you would never invest in this company if you wanted to buy 170,000 shares. Otherwise, if you try to sell it, you're going to drag it down. So always look at liquidity. And so when it comes to less liquid stocks, like stocks in the Russell 2000 index or the Wilshire 5000 index, or microcaps that have a market cap of $50 million, make sure they're plenty liquid first. But I love what you're doing, because when I invest in stocks, when I do due diligence, I always look for what's called a 5x5, meaning a 500% return within 5 years. Am I most often wrong? I'm almost always wrong. But if I'm right a little bit, meaning it's up 2 or 3x, then I'm laughing. And the way that you do due diligence to uncover 5x5s, meaning 5 baggers, is what you're going to want to do is you're going to want to use this spreadsheet that I provide my clients with. You can always go to learn.harounventures.com to learn more. I don't want to pitch my stuff. I want to teach here. But you want to fill out this entire thing. It's kind of like a business plan, right? And you never want to start a company without writing a business plan, because failing a plan is plan to fail. And it's the same thing with stocks. You want to write a full business plan and value the company as well using different valuation methodologies. Okay, 3 different valuation methodologies. Okay, And I've got one also for real estate. I have one for every type of investment class for my students. Let me move on. We lost a couple people there. Okay. Next question is, with companies that develop drugs, yes. Isn't it more risky to invest, as it is impossible if they will be approved or revoked, or competition will come with something better? Yeah, it's very, very tough investing in biotech stocks because there's usually a binary event that makes a stock go up a lot or down a lot when they get FDA approval, for example. So what a lot of portfolio managers do that invest in biotech stocks is they don't buy just one company, unless it's like a mega cap. They buy a handful, like maybe 10 micro caps. And it's a pray and spray mentality. So if one takes off and there's a binary event to get FDA approval for something in clinical trials, then you're laughing. You're going to make a killing. And I learned this from a good friend of mine. He used to manage, I think he's the head of research now at Franklin Templeton, but he used to manage the biotech fund. So his name is Evan McCullough. And what you can do if you want is do a search on Evan right here. He's been at Franklin for 8 million years. Our kids are great friends. Do a search for him. You'll see him interviewed on CNBC all the time. Yeah. So anyway, wow, 32 years. Good for him. All right. Okay. Next question is, when Peter Lynch wrote his book, I've got it here. Oh my God, man, you are me. When Peter Lynch wrote his book, Went Up on Wall Street. Okay. And by the way, Peter Lynch was one of the best portfolio managers in history. He was a growth investor, sort of. And he worked at Fidelity's Magellan flagship fund in the 90s. And the way that he made a lot of money was he only invested in what he understands. I recommend you guys all do the same thing as well. So, for example, as he mentions in this book, his wife went to the drugstore and bought lots of pantyhose that came in an egg-shaped carton. And she was like, oh my God, I love this product. I've tried it. I've used it. These guys invested as well, did very well with that. Only invest in what you understand. Okay. All right. So your question is, yeah. So when Peter Lynch wrote his book, he said a PE over 50 is very high. What is the number nowadays that seem very high no matter what? I think that's irrelevant, in my humble opinion. As I was mentioning earlier, you have to look at the growth rate. And you have to look at earnings years from now. So if you're looking at NVIDIA, if you've done your own research on it, and you think that earnings are going to be so damn high in 10 years that the company is trading at a PE of 1 right now, what matters is future earnings, not in hindsight. Always look forward. Always look forward and think long term. And when Warren Buffett invests in stocks, he always tells himself after he buys a stock that he's assuming that the stock market's going to be closed for 10 years. Now, of course, he knows it won't be closed, but that's how long-term focused he is. And I want all of you to be the same way too. And I say it with love in my heart, because we've all, myself included, we've all bought a stock that was a great growth stock, and we sold it because it went down a little bit. And today it's much, much higher. Do your research and invest for the long term. Okay. Don't panic. If you panic, you're going to sell at the worst time. And don't listen to anybody, including me, in terms of what stocks to buy. Do your own research, and that's what I teach you in my MBA degree programming courses. Yeah. All right, next question I've got here is, if you start now to build a portfolio of 20 stocks, good, and you do it well, it seems it will take a year to allocate 3 hours per day, etc. Yeah. Yeah, I love your questions. Keep them coming, Ray. They're fantastic. Yeah. So what Ray is referring to is good portfolio management and risk management. And what that means is this. I want all of my students and clients, and I've got 2 million paying students in every country in the world, humbly. I want you all in your portfolio to have at least 20 stocks. So what that means is no position can be more than 5% of your portfolio. And that's good risk management. Also, I don't want you to have more than 20% in one sector, like technology or healthcare or financials or industrials or retail or consumer goods, whatever it might be. And for those of you outside the United States, I want you to be careful about foreign exchange risk as well. Like, don't have all of your eggs in one basket, meaning don't invest only in US stocks. You want to be globally diversified. Yeah. In terms of, oh my God, Chris, if it takes me 3 hours a day to do research, I don't have time, then just buy ETFs. Yeah, buy ETFs until you have the time to do your own research on stocks. ETFs are very diversified. Now, in terms of how do you buy ETFs? How do you do research on ETFs? Well, there's a great free website called ETFDB, and that stands for ETF database, okay? ETFDB right here. And what you can do right here, and never buy mutual funds, by the way, because they're a scam. The fees, including hidden fees, are 5% per year versus 0.1% for a lot of these ETFs. So you go to ETF Screener, you can screen based on country, etc., yada, 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 invest in technology, the technology stocks within the NASDAQ index, etc. So I'll let you guys play around with that. Now, where I put my money, and I want you to do your own research first, please. Where I put my money when I don't know where to put it, and I'm diversified across real estate and tons of industries. As a placeholder, I usually just throw it in the Vanguard S&P 500. So this represents the 500 stocks in the US markets. And I humbly think that this index will be up 15 to 20% on average for the next 20 years. There will be big down years in between, I promise you. I don't know when, I don't care. I'm thinking longer term. So when you look at this, you want to look also at the expense ratio. So this means you're only paying 3 pennies in fees for every $100 you invest each year. Do your research first though, please. All right, let me get to the next question. All right. All right, next up, Marin, how are you? And Marin is one of my incredible students, and I'm building our second school right now, actually, in Kenya with Marin. And let me show you the school really quickly here. Okay. And the reason I do what I do is a lot of the profits go towards building school. I'm going to build 1,000 schools in my lifetime in Africa. And if I was a quota-carrying sales rep, I promise you I'd be fired so many times. But as James Cameron said, the great Canadian represent director, he said, if you set your goals really high and you fail, you still fail above all expectations. So here's Marin right here. She's one of my amazing students. This is in Kenya. We're building a school for girls. We got a board of advisors, and I want to thank also Udemy for their support as well. And then Marin's father actually had a scholarship when he was a kid in the 60s in the United States, and he actually got to see Martin Luther King's I Have a Dream speech live. I met with him, great guy. So you can go here, just kenyaschoolforgirls.org, just to learn more if you want. If you're a big corporation and you want to donate a large amount, you can always reach out to me as well. Yeah, and here's a conversation I recorded with them. And here's a school we actually finished in Rwanda a couple of years ago, right? And anyway, I love these kids. This is Vital, one of my students. There's us cutting the ribbon with the Department of Education. That's what it looks like on the inside there as well. Okay. We all have to have a purpose for what we do. Okay, next up, Purnell. Hey, Purnell. Purnell wrote, hey, Chris, what is an inverted yield curve and what is a yield curve? Why might this be important for an investor? Absolutely. I'll show you guys this. Now, what I'm about to show you has a dramatic impact on all of your net worth. Okay. And if anybody wants to own a house or stocks, what I'm about to show you will impact your net worth big time. So let me first of all explain what a yield curve is and how the government decides what interest rates should be in the United States. So let's go together to treasury.gov. Okay. This is the United States Department of Treasury. And you can always go to data and then look at the yield curve. Okay. And this will make more sense to you in a second. Let me get the current month. Apply. Okay, good. All right. So right now, okay, as of today or yesterday, 1 month rates are 4.38%. Okay. Now the short-term rates here are set by the United States government. And the way they do that is they actually, and I'm going to show you with a real example here of a bond from 1944 to fund World War II. The way the United States government changes interest rates is they do the following. Okay. Let's go back in time. It's 1944 and there's this war in Europe. Okay, so I'm the United States government, or the Federal Reserve, it's a separate entity, and you're all consumers or banks or investors. I'm going to sell you this bond, okay? And the purpose of me selling you this bond is I want your money. Uncle Sam wants your money so I can build tanks, etc., to destroy the Nazis. So I'm going to sell this to you, okay? And in return, you're going to give me your money, okay? So I'm going to take this money that you gave me, okay? And I'm going to take some of it out of circulation. Okay, so some of it I'm going to take out of circulation. So, and then some of it I'm going to make tanks, airplanes, etc., to help our friends in Europe. So I took some of it out of circulation. And whenever the supply of something goes down, the price goes up. For example, when Nintendo releases the Switch 2 later this year, you're not going to be able to get it. It's going to be sold out everywhere. So instead of being able to buy it for $499 because supply is low, you're probably going to have to pay $700 on certain websites like eBay. It's the same thing with money. You take money out of circulation, supply goes down, therefore interest rates go up. Okay, that's how interest rates are set. Well, how does the government cut interest rates? Well, I do the opposite. I buy this bond back from you. Okay, now what I did was I put more money out there in the system, and supply up, price down. That's how interest rates are changed. Let's go back to the yield curve and explain more now. All right. So this is how the government sets short-term interest rates right here. Oh, that's a new one. This wasn't here before. Now, the long-term rates, meaning the 30-year rates, they're set by the marketplace. So right now, we see that long-term rates are higher than short-term rates, and that's a healthy yield curve. Let me show you what that looks like visually here. So yield curve. And then I'll explain what inverted means in a second. So this here is a healthy yield curve, okay? And what this means is that, here we go. What this means is that rates are higher in 30 years, assume that's 30 years there, than they are now, okay? And that's a healthy yield curve because what the market is saying, remember, the market sets the long-term rates, 30-year, government sets short-term rates, 1 month. So if rates longer term are higher than short-term rates, what that means is people are saying, hey, the government's going to raise interest rates in the future, which means the economy is going to be growing and doing well. And the United States government's going to have to cut rates to slow down the economy. That's healthy. That's a healthy yield curve. Now, when Biden, who was a brutal president, but when Biden was president, it was inverted because nobody had any confidence in him. And I'll show you what it looked like. Inverted yield. And I'm a libertarian, okay, just so you guys know. All right, so an inverted yield curve looked like the one on the right here, okay, and this is exaggerated. Healthy yield curve, inverted. So when Biden was president, short-term rates were here, long-term rates were lower, okay, towards the end of his presidency. And what that signaled is that people were not confident in the long-term viability of the U.S. economy. And because rates are expected to be lower in the future under the Biden administration, what that means is things are going to suck in 30 years or in the long run. So the government's going to have to cut interest rates. So this is a healthy yield curve, normal, which is where we are right now. It's not massively normal. It looks like this, really. And this is an unhealthy yield curve. Okay. And usually when you have an inverted yield curve, it means that the probability of recession goes up. But don't ever listen to economists. And I'm going to butcher this quote. But economists have successfully predicted 7 of the past 58 recessions. Yeah. But if you think long term when you're investing, it doesn't matter how the economy does. Yeah. Okay. Next question is, can you please explain what a recession is and what causes one to occur? Absolutely. So a recession means 2 consecutive quarters of negative growth year over year for revenue for the economy. Revenue for the economy, and I'm simplifying this, is GDP, gross domestic product. So if GDP goes down 2 consecutive quarters year over year, then we're officially in a recession. In terms of what can cause a recession, it can be if inflation is crazy high. And let's say, and I'm going to make this up, let's say that Canada retaliates and makes tariffs on U.S. goods of 100%. They wouldn't do that. It'd be crazy, right? And then the United States says, hey, that's not fair. We're going to make tariffs, I'm exaggerating, on all Canadian products 200%. And then China, basically says or U.S. says to China, I'm now going to make tariffs 50% on you. Well, everything becomes more expensive. And if everything is more expensive, consumers stop spending. And that's disastrous for the economy, right? And if the price of everything goes up, the government has to raise rates materially. And so back in the early 80s, under the Jimmy Carter administration, Paul Volcker, who is the Federal Reserve chairperson, that raised interest rates close to 20% at one point because inflation was almost that high. And the economy grinded to a halt, right? It was deadly. It was deadly. And if you think about it, if interest rates are, and I'm going to exaggerate here, if interest rates are 25%, what are you going to do with your money? Well, you're going to put your money in the bank, right? Because it's no risk. Are you going to buy stocks? No way. Are you going to invest in venture capital or cryptos or NFTs? People still invest in that crap? No. You're going to keep your money in the bank. And so when interest rates are ridiculously high, every other asset class does crap. Okay. Next up, we've got, and please continue to type your questions, everybody. Tommy wrote, how is appreciation earned when money is in a bank account? Do you receive appreciation payouts monthly or yearly, or does that matter? Now, it just sits there and goes up in value if interest rates are positive, which they are, not massively positive. And then when you take your money out, you get the higher amount. That's it. That's how it works. Yeah. Now, how do banks change interest rates? Well, earlier I explained how the Federal Reserve, United States government, when they sell bonds, okay, and if they sell you bonds, then you give me your money. I take this money out of circulation. Okay, less money means higher interest rates. The reality is, through these open market purchases from the Federal Reserve, the reality is that it's the banks that are really buying wholesale. Okay, so the banks buy wholesale and then they sell it to us retail. So it's kind of like, I don't know, Walmart buying, if Walmart was to buy money from the United States government, right? That's wholesale. Walmart's like a bank. And then they'll sell it to us at retail, a bit of a markup as well. That's how the monetary system works. Yeah. All right. Next question is, a lot of questions. Okay. And by the way, I won't be able to answer all questions in 45 minutes. I do have to go. If you're in my silver, gold, platinum, diamond program, you can join the 3-hour Zoom call later today and ask me questions and have me look over your financial models or LinkedIn profile, whatever you want me to do. I'm here to serve. All right. The next question is, to be a successful investor, what are the most important things to understand about the economy? Yeah. So if you're very long-term focused, it matters a little bit less. Okay. If you're shorter-term focused, the most important thing to understand is where are interest rates going. And what you want to do is every couple of weeks or so, the FOMC minutes are released, meaning the Federal Open Market Committee, meaning the Federal Reserve releases, a document that says, here's what we're thinking. And what you have to do is compare the current minutes to the previous one. And we dissect every single word. So if the last time the Federal Reserve, United States entity that controls interest rates, if the last time they spoke, they said, we are somewhat worried about inflation. And if we use ChatGPT to compare the current statement to the previous one, and the current statement says, we are very worried about inflation, then that signals to the marketplace that the Federal Reserve is going to raise interest rates more than expected. So the bottom line is the biggest economic data point to really look at is going to be interest rates. Yeah, and there's other things you can look at as well, like ISM manufacturing data, consumer sentiment, et cetera. But just stick with interest rates and unemployment as well. Everything goes into interest rates. Yeah, and I can discuss any of those in a lot of detail if you want me to. All right, next question we got here is, okay. How would you explain how money works to a person who has no real concept of it? Yeah. So the way that money works is the government prints it and they put it out there in society. And as I mentioned earlier, if more money is out there in society, that means the value of money goes down, meaning inflation goes down or interest rates go down. If less money is out there, take this out of circulation, then that means that that interest rates go up. That's it. And cash is trash. This is garbage. And the reason this is garbage here is, by the way, the United States dollar looks the same today as it did back in the 1930s, just like that. And the reason is because monopolies don't have to really innovate. And that's why cryptocurrencies is a huge, huge thing. So cash is trash. So the amount of money out there today versus the pre-pandemic levels, I think it's like 40 or 50% higher. That's not fair. If you live in the United States, you work really hard to make money. This has gone down a lot in value because the government printed, or the Federal Reserve printed a lot more of it. That's not fair. Cash is trash. That's why you need to diversify by stocks, bonds, commodities, tiny little bit of cryptos, real estate especially. Okay, yeah. The worst thing you can do is just sit on cash. All right, and the biggest threat to national security is cryptocurrencies. Okay, so in a lot of left-leaning countries, socialist countries or communist countries, they're making cryptos illegal. Okay, and the reason is this whole process of me changing interest rates by selling you this bond and taking money out of circulation, that's important Because if I'm the United States government, that's the only way I'm going to be able to raise money to, I don't know, to fund World War II or whatever it is from you, the public. Now, this is an exaggeration, but let's assume that all of you tomorrow started saying, you know what? I'm not going to keep my money in US dollars anymore. I'm going to keep it all in cryptocurrencies. Well, that's the biggest threat to national security, because if you only buy cryptocurrencies like Bitcoin, etc., then you don't buy US dollars, and the US government cannot sell you this bond to be able to use the money to create tanks and airplanes and stuff, etc. Again, this is a sample from World War II, a real sample. So it's the biggest threat to national security. Yeah. And I think that Bitcoin at some point, please do your research first and wait for a dip. But I really do think that at some point in my life, meaning the next 200 years, Bitcoin will be $1 million per share. Yeah, per coin. Yeah. All right. And I can talk more about that if you want me to. Yeah, but most cryptocurrencies are an absolute scam. Be careful. And never have more than 5% of your liquid net worth in cryptocurrencies. I've been saying that for many years, since 2013, since I started investing in cryptos and was on the board of crypto companies as well. All right. Next question is, are you an accredited investor and would you recommend becoming one? Yeah. So the way it works is most governments won't let people, regular people, invest in really risky stuff like hedge funds, private equity, venture capital, unless they are what's called an accredited investor. So an accredited investor, depends what country you're in, usually means somebody that has a liquid net worth of $1 million and makes a couple $100,000 per year. That's what an accredited investor is. Yeah. Okay. Next question is, what's more valuable, financial acumen or business acumen, and why? I would say financial acumen, because if you understand the future value of earnings potential, you're going to be worth a fortune. Let me show you a very quick exercise we can do together that's going to blow you away. This will change everything when it comes to you thinking about money. So what I'm going to do is, and you can do this with me, okay, I'm going to ask you a question. All right. So what I'm going to do, and this is from my real estate course. So what is your monthly rent? Let's say it's $3,500. Okay. And if you rent over 50 years, okay, at $3,500, then that means 3,500 times 12 times 50. That means $2.1 million. Okay. That's what you're spending on rent versus owning. But let's say, and this is an exaggeration to prove a point, let's say that you invested that money instead at 15%. Would it be worth more than $2.1 million? Yes, it would. Guess how much it'd be worth. You ready? This is crazy. Okay, and this is just the time value of money from a financial acumen perspective. It would be worth almost $500 million. Start saving now. And as Warren Buffett used to say, you want to spend what is left after saving instead of saving what is left after spending. Out of sight is out of mind. Have your money taken out of your paycheck every 2 weeks and put directly into your 401k or retirement savings program if you're overseas. It adds up. And if all you did was you took the 20 or 22K you can invest in your 401k or retirement savings program every single year and you invested in the S&P, that's all you did. And you didn't even monitor it, you'd have over $1 million in 20 years and you sleep at night. If your spouse did it as well, you'd have over $2 million. If you have kids, and I have 3 kids, are a lot older now, but what you can do with kids is you can invest in educational savings accounts. So if you invested 15 grand per year for each kid, tax-free in their educational savings account, I know it's tough to do that every year, I get it. Then for each kid in 18 years when they go to university, you'll have 700K. So you got 700K for each of these guys. Okay, so that's 2.1 million. Plus the $2 million from you and your spouse saving. That means you have $4.1 million in 20 years. And that doesn't even include, real estate investments you have. And it's my goal that my students, I want my students, and I say it with love in my heart, I want my students within 10 to 15 years to make more money from investment rental properties than they do from their base salary. And it's something I teach. And I recently added a complete real estate elective to my program. I'll show you just very quickly here. I don't want to be selling here. Okay. All right. So I'm going to go here. So if you go to learn.harounventures.com, you can buy my complete real estate course for $499, or it's included for free in my silver, gold, platinum, diamond programs. Please note that my silver program price is going to go up by 300% very soon. I'm just telling you because I don't want people to be upset with me. Okay. Dude, that little piece of light is killing me. I'm so sorry. I've got a... Salvador Dali said if you strive for perfection, you'll never reach it. Oh my God. Okay, I think I got it. Oh, it came back. Okay, we'll leave it. Yeah. Don't strive for perfection. As Reid Hoffman said, the brilliant co-founder of LinkedIn, if you strive for perfection, you'll never reach it. He also said actually, that was Salvador Dali. If you release your product, when it's ready, you've missed the market. It's too late. Yeah. Okay. All right. One quick side note. Okay. So LeBron James, he just reached a massive milestone of 50,000 points. And I want to talk about confidence very quickly. So LeBron James, when he's sitting on the bench, you'll see his eyes are closed a lot of the time. What he's doing is he's meditating. He's meditating, thinking about himself getting the shots in. And I want you guys to do that as well. I want you to meditate every day about success. And studies have shown that if they have a group of high school students practicing shooting baskets versus a group of high school students thinking about practicing shooting baskets, the outcome is almost the same. Confidence is key. And it's like the Rodin sculpture. What you think you become. Okay? So I want you guys to all understand that you are always your own biggest enemy. People aren't judging you. They're not thinking of you at all. They're thinking of their own problems. It's like Yogi Berra, the late great Yankees player. I hate the Yankees. I like the Blue Jays. He said that baseball is 90% physical and the other 50% is mental. It's all in your mind. And the same thing with golf. When I golf with my kids, it's the exact same thing. If in my backswing, for you golfers, you know what this means. If in my backswing, I tell myself, this is going to be a crap shot, it always is. Right? So anyway, perception becomes reality. I thought that was important to mention about LeBron James, given his big milestone. All right, next question is Jeffrey, who's one of my MBA students, who wrote, "Hey Chris, Carib yes, red stripe no." That's right. He's a Trini. We don't like Jamaican beer when we talk. That's right. Yeah, just kidding. You wrote, "Great to have you back. Can you share your views on foreign exchange trading and participating in the activity?" Yeah, please don't ever do it. Day trading does not work in any asset class. Okay, swing trading might if you're focused on a couple months. Day trading doesn't work. I need to get down on my knees. Please don't anybody day trade. You will lose your money. Why? Because if you day trade on a short-term basis, meaning 1 month at a time, every month has 20 weekdays. That means the markets are only open for 20 days, the equity markets at least. FX a little bit different. And stocks go up and down in a short amount of time for stuff out of your control. It could be something Trump says. Or, I gotta be careful here. Or it could be because of some economic data point. Or it could be because one company, I don't know, announced really good or bad earnings. You can't make money day trading. You have to be long-term focused. FX is even harder than equities day trading. I don't know. I didn't know the ECB today would imply that rates are going to be lower than expected because of tariffs. We can't control that. So I'm vehemently against day trading. And I say it with love in my heart, as always, yeah. All right, next up, the Venture wrote, "What's the best credit card for a score of 763? So the way that credit ratings works in general is a maximum score. Credit rating is around like 850 or so, depending on the credit agency. And the way to get your credit rating low is obviously pay all your bills on time. In order to get a mortgage, a decent rate, you want your credit rating to be above 620. Yeah. Okay, moving on to Albert. Hey, Albert. That's my son Dylan's middle name. Albert wrote, "Hey, Chris, I hope you and your family are doing wonderful. Likewise. I wanted to ask, what are the main skills required to be a professional trader and how to train them? Thank you so much." Okay. So I'm against trading, but I'm going to show you just some trading stuff very quickly, okay? And before I go there, as I mentioned earlier, whenever you invest, the first thing you want to look at is fundamentals, okay? This is dummy data. The second thing you want to look at is valuation. The third distant thing is technical analysis, okay? So what you want to focus on is you want to focus on a couple things. One is the RSI, okay? And I'll go through this very quick. So this down here is the RSI. It's going to be hard to see. But this red line down here is an RSI of 20. And the green line up here, tough to see, is 80. If you see that the RSI touches 20 or 30, then buy. If you see it touches 80, like it did right here, then sell, because it's overbought. Okay? This is voodoo, a lot of it. It's self-fulfilling. It matters because it does this on short-term traders. What you can also look at is you can look at the 50 and 200-day moving averages, which are shown here by these two lines here. You want to make sure the stock doesn't violate the 50 or 200-day. And you want to make sure the 50-day does not cross down through the 200-day. That's called a death cross. Yeah. And the opposite of that is a golden cross. You can also look at channel formation, etc., which I showed earlier today when I was talking about Tesla. Yeah. That's it. Okay. All right. Tommy wrote, what determines the value of a stock? Yeah, expectations of future earnings, meaning how much cash they're going to make in the future. That's it. Yeah. But there's a lot more to it. Like there's actually 100 steps that I think determines the value of a stock. And you can go right here for those of you in my MBA program and download this file. There's 100 steps. And here I ask you 730 questions to fill in here based on 100 steps, and that will help you come up with the target price of the company. Okay. Okay. Hey, Cato, how are you? You wrote, just listening in and want to say hi. How are you? And hello to everybody that listens on Spotify and the podcasts we have on every major podcast platform, which we've been doing for 200 weeks now. A lot of people don't realize that. Yeah. Okay. Neo wrote, what's up, Chris? Hope you're well. Great to see you. My first question, have you heard about Germany's plans to use debt to upgrade mostly the military, but also to some degree infrastructure? How do you think this will impact the economy and inflation? Yeah. So whenever the government issues debt, like the United States government does, right, to build out infrastructure, it can help the economy. Okay. And I'm a big proponent of issuing debt and investing in infrastructure when the economy sucks. So maybe the economic outlook does not look that good in Germany right now. Therefore, when things are bad, it makes sense for governments to issue debt to be able to create jobs, to be able to build out infrastructure. So I'm a proponent of that to a certain extent. Of course, we don't want to take on too much debt. Yeah. Military, I get it. Yeah, things are crazy. I'm sure you guys all saw Zelensky at the White House. I watched that speech 3 or 4 times, the whole thing. And what was interesting is J.D. Vance. What got him mad, okay, I'm not saying who's right, who's wrong, but what got him mad was the body language of Zelensky. Nobody's talking about this, but you can watch for it. The second Zelensky went like this, right, he was closed. J.D. Vance lost it. Don't ever do this if you're in an informational meeting or doing an interview, because it signifies arrogance, right? I'm not saying that Zelensky is arrogant, please don't take it the wrong way, and closed-mindedness. Yeah, you can watch that if you want to, and look for the body language that way as well. Yeah. Okay. What you can also do is this. So when I worked at a very, very big hedge fund you've all heard of, management, the billionaire founder actually of the hedge fund, he brought in 25-year FBI and CIA veterans to train me and my team. And they trained me on how to tell if somebody is lying. And the great thing about what I'm about to teach you is you can use this in your personal business life, etc. And we use it to make sure that CEOs were not lying to us. Okay? And the bottom line is the way that you know that a CEO is lying is if they move their lips. I'm just kidding. No. There's 4 ways to tell if a CEO or anybody might be lying to you. And what I'm about to explain to you is more of an art than a science. Take it with a grain of salt. There's 4 things. And maybe, I don't know, 2, 3, or 4 of these have to be valid from what I'm about to teach you, for you to maybe assume somebody may be lying. Number 1, somebody breaks eye contact with you when answering a question. Okay? As long as they don't usually do it. Like for me, I tend to look down a lot when I talk. It's just my demeanor. So again, number 1 is eye contact. And you'll see this with kids especially, or if you're in a relationship, or athletes that are being interviewed on television and they're being asked, do you want to sign with your current team after the season ends? If they break eye contact, there's a chance they're lying. That's number 1. Number 2, If somebody rambles on and on and on and on and on to a simplistic question, they might be lying. And you see this with children a lot too. You tell your kid, did you take all those cookies from the cookie jar? And the kid goes, oh, how could I do that? I mean, I have to get the ladder over there and put it over there, et cetera. And oh my God, there's a lot of crumbs on my face right now. But of course I wouldn't do it. Okay, rambling. Number 3, or threeth, as my son Andrew used to say. The third way to tell if somebody is lying is if they touch their face. Okay? Now, if they touch their face, as long as they don't do it all the time, but if they touch their face or cover their mouth more often than usual, that could indicate they may be lying. And the fourth thing, for those of you that have seen Meet the Parents, and I was once in a movie with Ben Stiller, and I could tell you why and all that stuff. It's funny. But if you see Meet the Parents, you'll see that he was hooked up to one of those lie detector tests. Now, the way you can tell without using a lie detector test if somebody might be lying is if they start shaking their foot a little bit more than usual, as long as they haven't had too much caffeine. Now, all 4 of these, maybe 3 of the 4 have to be valid for you to maybe think that somebody could be lying. It doesn't always work, but try it in your business and personal life. I promise you, it'll surprise you. Okay. And then Cato wrote, invest in things people are going to like. I love that. Yeah, it works, man. It makes you think longer term as well. And it's all part of what's called catalyst investing. And when I used to manage money professionally, I would love to invest in companies that investors are going to like. And a great example of this was back in, I think it was 2012 or so, we invested in Lionsgate Film, ticker LGF. And the reason was, and at that point in time, I'd read the Hunger Games books, but Lionsgate Film announced that they were going to make, Lionsgate, they were going to make the Hunger Games movies. I thought it was going to be 3 movies, but it was 4. And so what that meant is this. And Carter, by the way, credit goes to Brian Carter, a buddy of mine who came up with this trade. He's a brilliant man. But what that means is this. Every time the Hunger Games movie came out, 1, 2, or 3, investors would get excited. That's a catalyst. So invest in companies people are going to like. Yeah. All right. Okay. Oh my God, D'Angelo, it's been a while. Great to see you. I remember last time I talked to you, you were in my platinum program years ago, and you were an actor, and you didn't live in Hollywood. I remember telling you, if you want to be an actor, move to Hollywood. Kind of like if you want to work in finance, move to New York. I hope you've done well, man. I'm on IMDb now as well. You can search for it. I've got a Wikipedia page as well. They made it for me, I guess. Yeah. Great to see you. So D'Angelo, who's incredibly charismatic, wrote, long time no see. Hope you're doing well. I'm scaling back on my full-time job to focus on acting. Excellent. Remember to network like crazy. Your network is your net worth. Relationships are more important than product knowledge. You wrote, any advice for my proposal? 11 years of experience. I'm submitting it tomorrow. Yeah. Tell you what. Today why don't you join the weekly office hours, because you're a platinum student, so you're grandfathered into all office hours forever. It starts at 10 a.m. And if you don't have the link for it, just email support@harounventures.com, and I will go through with a fine-tooth comb to help you with the documentation to help you. Yeah. Okay. All right. Sean wrote, hey, Chris, thank you for hosting these office hours. 99 is the GOAT. That's right. 99 is the GOAT, the greatest of all time. That's Wayne Gretzky. Of course, Sean, great to see you. Sean has got the best LinkedIn profile ever. Let me show you here. He is a sleep expert. If you want to learn how to sleep gooder, Sean, here we go. So here's Sean right here. Reach out to him. Read articles as well that he's posted here. He's helped me out tremendously as well. He is brilliant. Sean, great to see you, brother. It was so good connecting with you in a one-on-one recently. Okay, moving on to Boss SMG. Hey, Boss. Hi, Chris. Hope you're doing well. How can I market a mobile app or a software as a service? Thank you so much. Yeah, it's very hard, but what you have to do is you have to give it away for free and focus on subs, okay, the growth in subs. And I'm going to give you a great example here of Evan Spiegel with Snapchat when he launched the company years ago. So what Evan Spiegel did was he came up to Silicon Valley to meet with a lot of venture capitalists that I know. And he said, I have this app that I think is going to do really well. And the venture capitalists from the top firms were like, okay, well, tell me about this app. And he said, well, it takes pictures and then the pictures disappear. And these venture capitalists were like, that's the dumbest business model I've ever seen. Why would I want to take pictures of my kids and have those pictures disappear? Pass. Then a couple years later, he came back to Silicon Valley, okay, Evan Spiegel, and he met with the same venture capitalists. And he said, yeah, remember me? We're trying to raise money. And the venture capitalists were like, oh, yeah, that's right. Well, give me an update. And he said, well, we have 6 million downloads of Snapchat. And the venture capitalists were like, oh, my God, that's the best business model I've ever heard of. So all that institutional investors and retail investors or high net worth investors are going to care about is the number of subs you have. So you want to have a low end tier that's free. Yeah. Kind of like how this weekly call I do is free. And then I'm able to upsell to other products. Yeah. But I do love doing this. It's fun for me. All right. But there's so much more to it as well. And in my MBA degree program, I've got a venture capital boot camp as well. It's in the 3rd semester. And in the venture capital boot camp, I teach you how to write a business plan from scratch. And then I take you through all the steps of writing your business plan. And then you create your business plan here and then your investor slides here. Okay. And you need to have a full business plan for your go-to-market strategy before launching a company, or it might fail. Yeah. And I was part of the Stanford Graduate School of Business MBA program as a guest lecturer and a mentor of tons of Stanford MBA students with their business plans. And I've incorporated that into my MBA degree program. So hopefully it helps you out as well. And if you want to learn more about what venture capitalists look at, the professor that I taught in his class, his name is Ilya Strebulov. He's the #1 venture capital professor on the planet. I interviewed him probably 4 or 5 months ago on my YouTube channel, and he talked about his book. Check it out if you want to. Just go to my YouTube channel to look at it and buy this book as well. Ilya is the best. Follow him also on LinkedIn. He's a top voice. And he is basically the smartest dude on the planet when it comes to understanding venture capital. Yeah. Okay, Javesh, first time I see you on the call. Hope you join us again. Javesh wrote, hi, Chris. I really appreciate your teaching style. Thank you. I've enrolled in a couple of your Udemy courses. Thank you. Do you have any course on fundamental and technical analysis on Udemy? Yeah, I mean, I do talk. I recommend checking out my MBA degree program instead on my website. Go to harounmba.com. But I think I have a course called the Complete Financial Analyst course on Udemy that might help you out as well. I talk a little bit about technical analysis, but more so about fundamental analysis. Yeah. Okay. Okay, next up, ROS wrote, I want to join a hedge fund like P72, that's 0.72. That's Steve Cohen's hedge fund. He's growing. He just raised another $5 billion in capital. It took him 10 days to do so. He used to run SAC, which got shut down because it was a criminal institution. I want to join or Citadel, where I used to work, or MLP, that's Millennium Partners, Izzy Englander's company, or BAM, which is Balyasny. Yeah. I want to join the United States as an international student. What do you think is the best way? Should I join the CBS, Columbia Business School MBA like you did and recruit for the buy side from there? So what I recommend doing initially is I recommend setting up a ton of informational meetings, okay? So before considering getting an MBA from a traditional school, which is a rip-off, 100 grand, it wastes 2 years of your life, what I recommend that you do is the following. A lot of people go to business school because they want to change careers, but they haven't even tried to network yet. So I want you to do the following. Step 1, and if you want, you can join my MBA degree program. I have a lot of students from top MBA programs all over the world that join my program. They learn a lot more in 1 month of my program than they do in traditional MBA schools. The problem with MBA degree programs, and I have my Forbes column is going to talk about this, it'll be released next week. The problem with MBA degree programs is they don't teach you the most important things in business, like how to sell, how to network, how to present, how to get a job, how to manage your own money. They teach you how to manage other people's money. It's a waste of money. So you can try out my non-accredited version here. Okay, I don't believe in government accreditation. It's not fair that somebody that wasn't born with a silver spoon in their mouth, meaning they went to undergrad, cannot join an MBA program. So I would join mine if you want. Maybe start with silver if you want. Again, prices are going up 2 or 3x on this product. I'm just not trying to sell it to you. I'm just telling you guys are not upset with me later. But step 1, you want to make an amazing LinkedIn profile, which I teach you at the beginning of my MBA degree program. Step 2, you want to be able to network like crazy. And before you think about going to business school, I want you to set up 100 informational meetings. and set up 100 informational meetings with people that work in industries you want to work in. And if you can't get the job that way, then maybe think about getting a traditional MBA. And think about each of those 100 meetings as saving you $1,000. 100 times 1,000 is $100,000, which is the cost of a traditional old school useless MBA. Yeah. And my success rate on getting meetings with people I've never met before, leveraging LinkedIn, has always been 95%. And I don't say that to impress you. Rather, I say it to impress upon you the fact you can do it if you use my methodology. I can take my students to the water, but I can't force you to drink. And so if you sign up today for my MBA degree program, silver, gold, platinum, or diamond, we start right away on networking as well as your LinkedIn profile. Your network is your net worth. Relationships are always more important than product knowledge. Yeah, and I am perspiring here a bit. And when I do television interviews, or somebody always puts this on my face. Problem is my nose is so big, I go through these things really fast. Maybe I'm beautiful, maybe it's Maybelline. Please tell me somebody got that joke. I'm dating myself. Okay, we got 19 minutes, or actually about, I think 15 minutes left, then I have to go. Manas, how are you? Manas from Calcutta. He's a silver student of mine. Great to see you. Manas, I'll see you today also at 10 a.m. Pacific time for our weekly 1-hour Zoom call for silver students. Yeah. AJ wrote, is the VIX always a good indicator to buy? No, only when the VIX is at 80. Okay, so you wrote the VIX is at 23 and going high. Does it mean it's a good time to buy when it reaches 28 to 30? No, I'll show you. So don't just look at the VIX when deciding whether or not to buy riskier stocks. You want to do top-down and bottoms-up analysis. But let me explain VIX very quickly to everybody here. And I promise you, what I'm about to show you will one day make you a fortune. But you have to let me explain it first. All right. So this here is what's called the VIX. Okay. Now, I just want you to look at the blue line. Ignore every other line you see there. Okay. Let me go to maximum here. Let's go to all. Great. Okay, cool. So just look at the blue line here. So what the VIX means is the VIX was created by the Chicago Board of Exchange, where options are traded. It was created in 1990. And what the VIX does is it tells you what investors think the volatility of stocks in the S&P 500 will be for the next, 20 or 30 days. And so when the VIX is low, like around 20, it means there's not much fear. So the VIX is a fear index. When the VIX is high, meaning above 70 or 80, which has happened a couple times, there's maximum fear. And when the VIX is above 70 or 80, like it was in the fall of 2008, right here, you can't see it, but it was above 70 actually intraday. That's when you buy. Okay, and the VIX here in Q1 of 2020, when we had COVID, and the price of oil futures went to negative $20, which is crazy. Negative for oil. Right here, it reached over 80 intraday. So when you see the VIX, if it ever spikes above 70 or 80, which it will at some point again, and it's usually a black swan, meaning a rare event that causes it to do so, that's when you buy stocks. You back up the truck and buy. And I promise you, when the VIX, it will happen one day, is above 70 or 80, you're going to think it's the end of the fucking world. Sorry for swearing, but I want to get a point across. And you're going to think, I remember Chris told me to buy when the VIX is above 70 or 80, but I think the world's about to end, so I'm not going to do it. He's crazy. That's when you buy, because everybody else is selling. And I guarantee you, I put my reputation on the line. Do your own work first, please. But I guarantee you, in my humble opinion, you will make a killing this way. And smart investors did that. So in the fall of 2008, when we were within 24 hours of bank machines not working, the VIX was above 70. Warren Buffett bought a ton of shares, especially in Goldman Sachs preferred shares. He got a sweetheart of a deal. Smart money. Here, in Q1, you can look at the Form 4 filings on sec.gov. Elon Musk backed up the truck, meaning he bought a lot of shares in Tesla and made a fortune. It's going to feel like the world is ending when it happens, but I want you to buy that. And of course, you can still buy stocks along the way you like after you do your own research. Yeah. All right, moving on to Tommy, who wrote, what do governments consider as revenue in reference to GDP? Is it import-export? Is it determined by what companies report as revenue for the year combined? Yeah, it has to do with tax receipts, U.S. government deals, etc. There's some formula for it. Let me go to DeepSeek and look this up. I'm using DeepSeek while I can because I think it's going to be banned in the not too distant future in the United States. Okay, so I'm going to type here, explain GDP to a 10-year-old in 3 sentences, because that's my maturity. Okay, GDP is like a big scoreboard that shows how much stuff a country makes and how much money people spend in a year. Imagine adding up all the costs of toys, food, clothes, and services like haircuts that everyone in the country buys or sells. The bigger the number, the more the country is growing and well. Okay, what is the formula? Be brief. University level. Let's see. Why would anybody buy my courses when you can use ChatGPT? Okay. So the formula for, oh my God, I'm going to fall asleep, but I'll show you as well. Where'd it go? Did it just crash? Oh, here it is here. Okay. So the formula for GDP is this: consumption, meaning consumer spending. And by the way, consumer spending is 2/3 of the economy. A lot of people think it's big business. It's actually consumer spending. Investment by companies, government spending, exports, minus imports. So you nailed this part of it here. Yeah. Now, let me show you something interesting about DeepSeek and why I'm not a fan. Watch this. Of course, it's a Chinese company. Okay. What happened? I know my spelling sucks. In 1989 in Tiananmen. Yes, I made spelling mistakes. Let's see. I'm sorry, I can't answer that question. Yeah, so I can't answer that. Okay, watch this. What happened on 9/11? It's going to give us an entire encyclopedia. Yeah. So, anyway, let me shut that down. Let's move on to more happy stuff. All right. Next question is, Manos wrote, how do you treat extreme burnout, like on the edge of breaking yourself, going way too deep in the abyss? Any thoughts? Yeah, I'm with you. So when I used to work on Wall Street, I used to take off at least 1 day a year when I was mentally unwell. Now, we tend to take off a day for work when we're physically sick, like we're coughing, whatever. But I think we all have to take off at least 1 day a year when we're mentally not there, meaning burned out. It's a good investment for you. And it's another way of being sick. And if you go to work when you're burned out, you might have a CLM, meaning a career limiting move. You might be a little bit grumpy when talking to somebody, etc. So take at least 1 day off a year, please. Yeah. And the way to stop burnout is to take breaks, man. Like, we have so many great religions that thousands of years ago, our forefathers and foremothers knew burnout's a big deal. You got to take 1 day off a week. So for me, I'm Catholic. I take off every single Sunday. I don't work. And so are you. You're from Calcutta, right? Yeah. I take off every Sunday. I'm not allowed to work. Right? I'm literally not allowed. I don't check emails. I don't do anything. Okay. I have a lot of clients that will take off Saturdays, right? Like a lot of my Hasidic clients in New York. I have a lot of students, that practice Islam. They take Friday off. Take 1 day off a week, please. Otherwise, you'll burn out. And when I take Sunday off, Monday morning, I'm so damn productive. It's like 5x productivity. And what you can also do, Manos, if you want, is go to the very first lecture of your MBA degree curriculum and download this. Okay. This is the daily scheduling system. Okay. And this helps you get a lot more done every single day and boosts our confidence as well. If you want to get something done, give it to a busy person. But don't do these things on weekends. Weekends is for fun. Yeah. Yeah. And I have to pre-announce negatively to you guys. I'm so sorry to do this. But GTA 6 is coming out later this year. So there's going to be some days where I just don't show up. Okay. Just understand that. Okay. All right. Next up, Manas wrote, do you think the Canadian equities are shorts now owing to tariffs anyway? Auto tariffs are on hold for a month. Do you think Canada will be able to tariff back like they announced? Yeah, they will tariff back. It won't have as much of an impact on the United States, of course. I think Trump is negotiating, and I think he'll reverse a lot of these things pretty quickly, especially if the equity markets sell off materially, because I'm sure he watches the S&P 500 closely. And I think the reason that he put the auto imports tariff on hold was because of not just what the CEO of Ford said, which you can all search for online, but also because the market's pulled back, right? So he pays very close attention to the S&P 500, right? And he's negotiating, right? Don't just focus on what Trump says, focus on what he does. Yeah, more so what he says. Yeah. Okay, next up, Emporium Podcast. First time I see you on the call. Hope you join us again. EP wrote, hey, Chris, what is the typical benchmark returns for a venture capital firm? And what is the average fee structure for VC firm? Yeah. So the way it works with venture capital, private equity, and hedge funds is they make money in two ways. They charge 2 and 20%. 2% means they get 2% of the amount of money you invest every year. So that they can pay for salaries, rent, flights for travel, and meet with companies, etc. So if you invest $100 in a VC firm, $2 every year is going to go to fees. Okay. The annual management fee. Now, the big money for them is the incentive fee, which is 20%. Remember, 2 and 20. So what that means is every dollar that they make for you, they keep 20%. So if your $100 investment goes up to $200, you get $180 back. They keep 20% of that. In terms of returns, most venture capital firms don't really make money. It's true. Right? It's a misconception. A lot of my students think, hey, I'm going to go and work in venture capital so I can make a fortune. You won't. It takes years. I've had friends that are very senior GPs at top venture capital firms, and it's taken them 10 or 15 years before they get a bonus. So the way it works is this. The top 10 venture capital firms in the world have 1% of their portfolios in unicorn companies, meaning companies that have $1 billion market cap. Just 1%. So the other 99% are loser investments. And these are the top 10 the venture capital firms on the planet. Now, the number one venture capital firm by a mile is Sequoia. Okay, and you can go to their website, sequoiacap.com. Their percent in unicorns is a staggering 5%. They're unbelievable. And I remember Sequoia led the A round in a company, and the venture capital firm I was at, we led the B round. I had a board seat there as well. And I remember meeting with Doug Leone, who's the top guy at Sequoia. And I asked him, I said, Doug, how do you do? I had like an hour and a half one-on-one conversation with him because I asked. Remember, closed mouths don't get fed. And I asked him, how do you guys do it? How do you get this 5% unicorns? Like, what's your secret? And he said, well, there really isn't much of a secret. We tend to focus, number one, on the entrepreneur, and everything else is secondary. And I said, okay, great. Well, what kind of people do you like to invest in or hire or invest in as, in your portfolio of VC companies? And he said, and I'm going to butcher what he said, but he said something like this. We like to invest in people. There's something about them that makes them feel maybe different or insecure to the extent that they have a chip on their shoulder. And they want to prove the world wrong. And it's not about money for them. It's about putting a dent in the universe. They want to not sell their company for $1 million, not sell their company for $1 billion, not sell their company for $100 billion, not sell their company for $1 trillion. So what is it that happened to these entrepreneurs younger in their lives that make them feel that they're not good enough? Well, something happened. So for example, Elon Musk, and if you guys have read you should read the Walter Isaacson Elon Musk book. It's great, or listen to the Audible version. But in that book, Isaacson mentions that Elon Musk had the crap kicked out of him a lot when he was a kid. So he wants to prove the world wrong. Steve Jobs had maybe issues with who is his father, I don't know, and being adopted is a beautiful thing. Like, they just want to prove the world wrong. And for me, for example, and I'm nobody, but when I was in the 6th grade and the 8th grade, teachers at the school I went to, they want to fail me. And they sent me to a learning disability center for tests. And it was in Oakville, Ontario on Lakeshore Road called Chisholm. And that destroyed my confidence. So for me, I'll never sell this company for all the money in the world. I don't give a damn. I've had lots of offers for investments, etc. Never. I want to prove the world wrong. Like they say those who can't do teach, and those who can't teach gym class. And I suck at sports. You're all out of luck. But for me, I want to, I don't know, I love my students, and I treat you like customers, and I want to help you. It's not about money for me. It's about helping you. So I want to prove the world wrong as well. Okay, guys. Alexa, stop. I'm so sorry. I do have to stop this webcast. I have a call right now. Alexa, stop. For those of you in my MBA degree program, meaning my silver, gold, platinum, diamond, I'll see you at 10 a.m. today for our 1, 2, and 3 hour calls. For those of you in platinum, diamond, I'll do one-on-ones with you later today. God bless you all. Thank you so much. And speaking of Steve Jobs, I'm going to play this really short video that's going to change your life. I'll see you guys all next week. For those in silver, gold, platinum, diamond, if you have more questions, ask me later today in our Zoom calls. Thanks so much. God bless.
When you grow up, you tend to get told that the world is the way it is, and your life is just to live your life inside the world, try not to bash into the walls too much, try to have a nice family life, have fun, save a little money. But life, that's a very limited life. Life can be much broader once you discover one simple fact, and that is everything around you that you call life was made up by people that were no smarter than you. And you can change it. You can influence it. You can build your own things that other people can use. And the minute that you understand that you can poke life and actually something will, if you push in, something will pop out the other side, that you can change it, you can mold it. That's maybe the most important thing, is to shake off this erroneous notion that life is there and you're just going to live in it, versus embrace it, change it, improve it, make your mark upon it. I think that's very important. And however you learn that, once you learn it, you'll want to change life and make it better, because it's kind of messed up in a lot of ways. Once you learn that, you'll never be the same again.